This is Cowboy. He said he will be on shortly. So, had a beautiful trade overnight. We're going to talk about that. We are, of course, in the beginner live lab session. So, this is live over on YouTube right now. What I'm going to do is take a moment to spread the link around so people can come on and check us out over on YouTube. But in the meantime, if you are already in the YouTube chat, feel free to go in there and ask questions. This is, again, geared towards the beginners. Let me see here. Let me roll over to Discord really quick. And I will post the link. Okay. The link is spread. And let's see who we have live. Okay, we got a few people over in the private group. Okay, well, now that we have some people in, I'm going to go ahead and get started here. We are basically here to on this YouTube channel to teach beginners how to get in some trading basics, right? So we teach people how to build algorithms. That's what our website is built to do. And a trading algorithm is basically a trading method. It doesn't necessarily have to be coded. It doesn't have to be something that you have written into software where it trades for you, although we can help you get to that point. This is more about teaching people how to build a trading method so that they can learn how to trade. And then once they have that, once they know that that is successful, we can go ahead and introduce them to a coder, and then, move in that direction of having it coded so that they can, have it trade for them overnight, have it trade for them when they're not at the computer. So it's pretty cool stuff. We use TradingView for our software, and TradingView has a code in there called PineScript, and it's built specifically for coding, so it's not going to be as clunky as, say, Python, which would be used for coding over on other platforms like MetaTrader 4, things like that. And so for you beginner traders, a trading platform is basically like your brokers out there that you put your money with. They're gonna allow you to trade on their platform. They'll probably have a trading engine. They'll have a trade desk, and you can have the trades there. Or a lot of platforms are built towards using, there's like an API where it's an interface where you can connect to something called MetaTrader 4. So MetaTrader 4 will actually allow you to trade on, and a lot of platforms actually will only use MetaTrader 4 and not have anything on their platform for the actual entering the trades. So that's, something where if you're going to go on one of these kind of oddball brokers, you may have to use MetaTrader 4. So it's not, it's not a bad thing to know about. In fact, at some point I may do a class on that. But most people who are with us right now are on any of the major brokers. So they're going to, not have that issue. Their major brokers will have a trading desk right there, or perhaps have an API into TradingView. TradingView is a software that was developed, 5-6 years ago, maybe 7 or 8. And a lot of cryptocurrency traders were, kind of going on there to do the charting. It's they have a free version of it, but there's a low cost version. And, the subscription could be, I think it's like under $10 a month or something if you want to have a little more functionality. And I pay for the top subscription because this is what I do for a living, and I think that's a few $100 a year. It's you can get real good deals, especially if you buy around Black Friday and Thanksgiving and stuff like that. So but before we get too far, first thing I'll do is remind everybody that anything we say on the show is intended for educational and entertainment purposes, and it's our opinion only. So, if you're going to go risk your money, risk your capital on the markets, make sure that you consult a licensed investment advisor because you can lose money. It's a risky thing to do. Okay, that's the disclaimer, the official disclaimer. So let's see. We got a few more people stacked up in here watching us on both our private platform as well as YouTube. That's good. Let me see here. Now, we're over at algofactory.com, so I'm going to go ahead and put up a QR code for those who want to head over there and see what we do. We're extremely inexpensive. I actually got an email this morning from like a beginner trader. We have a few of those. We have a handful of beginners who have not traded before, and they're essentially learning how to trade inside our platform, and that's beautiful. I love it. So basically, we do have tools for that, although trading is an extremely broad concept. So, if I were to make, say, beginner videos on every single concept, that might actually take like thousands of videos, which is why I opened up this beginner live lab so the beginners can come in and ask questions. If you're a member and you're a beginner, then you can ask a question in our private Telegram. And of course, I can even design a whole beginner show around those questions, right? So that's why I opened this beginner lab, and I opened it up to, to the public. That's why the girl and I decided to do that. And please excuse the allergies. Just having a little allergy morning today, a little nasal congestion there. So that does happen. It affects that beautiful radio voice. What can I say? So anyway, if you click on that QR code, that'll take you over to our website if you're using the phone, or if you go over to the chat. Let me throw up the throw up this URL, and you can go ahead and use that URL to go find us as well. And if you're on YouTube, you just go to our main page, and our links are all on that main page for our social media, our website, all that stuff. But we're over at algofactory.tech, and we priced ourselves pretty low. Our competition is about 6 times our price for the same kind of a similar type service. So understand that that's a low price. And what's great about that is if you get into this tier of service at $49.99, you will be able to have that grandfathered in as we add to Algo Factory, and the price goes up, because it's we're gonna have to raise the price, keep the doors open, to be honest. So I don't know when that's going to be. I don't know if that's next month or next year, but it's going to happen at some point. So if you're in and you stay with us and you don't let your membership lapse, you get to keep that price. And that's a good deal, seriously. So that is our, that's the, pitch, if you will. I'm going to go ahead and bring up a screen here. We're going to take a look at a trade that I took actually 2 days ago. And I took this trade pretty much live. I kind of mapped it out for our private group, and so they saw even before I would start this trade what I was going to do, while I was going to do it, and I went ahead and entered that trade, and we've been following it for a couple days, and it is out as of this morning. Profit has been taken. It's a beautiful trade. For those of you who are in our group, you're going to know by now what a risk to reward ratio is. So being this being a beginner class, I'll go ahead and explain that. This green box that you see, that's going to determine the risk to reward ratio. That's going to help me map it out. And what that means is, in Forex and pretty much any market, what I do is most traders are going to do is they have something called their risk. Okay. And so a risk is where if your trade stops out, if the trade goes against you and you decide you get out to stop the bleeding, and that we always have a stop loss, at least I do. If that happens, you're going to measure how much money you're going to lose here. You're going to always have a certain amount of money that you're willing to lose on a trade. Okay. And this is called money management. And so that's a big concept. And maybe we'll talk about that this morning. Okay. So with money management, what you're doing is you're making sure that you don't lose all of your money. Okay. So let me go ahead and write that up here. Okay. So with money management, and I see a question from Be Good on there. I don't have any data. Be good as far as flipping long on this. There's no indication of that happening anytime soon. This is probably going to go short for a while. So, what I'm looking for on this trade, I'm going to answer this question for Be Good really quick. He asked a question that's kind of more for, for a private group, but that's fine. So this at some point is going to head up and then head down again. That's most likely what's going to happen. So I'm not looking to go long at all. I'm looking for a chance to actually go short again. All right. It's pretty heavy short power right now. So money management is basically a tool where, Be Good. I've already answered the question pretty much. So money management is where you're going to determine how much you're willing to lose on a trade, and kind of a typical number is going to be 2% of your book. Now, what does that mean for a trader, right? So your book, if you will, is going to be the size of your account. Okay, so let's say you have $10,000. That's a decent sized account to start with in trading. It's 10,000. You'll be able to, if you're now, first of all, I wouldn't start trading any money until I knew and I had tested my method and I knew that it worked. Another word for method is algorithm. But let's just say that you've done all that. You've learned what you're doing. You've tested. You understand to a statistical degree of probability how much you're going to win on a given trade. And so you kind of have that confidence built up, right? So, okay, you're at that point where you're ready to go live, and you actually have gone live with small amounts of money, and you've forward tested. So you're at a point where you're ready to actually trade the full size, the full, position size that might make you some real money. All right, so let's just say you have $10,000 in your account. Well, what a lot of people do is they trade 2% of their entire account on each trade. And that's what I do. Now, sometimes it's a little more, sometimes it's less. I have a bit of a scoring system that will help me determine if I want to say, oh, well, this trade looks really good based on these factors, which are mathematical factors. I might go 3%. Or this is a weak trade, but it still fits my algorithm. It still is there, but it just barely makes, it barely fits the bill. So in that case, I will only put, say, 1.5%, whatever it is, but it rotates around 2%, and it's almost always 2%. So that being the case, each trade is going to be $200. That's what you're going to risk. Okay. Now, if you lose that trade, your account is now going to be $9,800. And then the next trade is going to be 2% of that. Okay. Now, if that's the case, then it's going to be like $198 or something like that, right? Let me see what it actually is. Get my calculator out because I don't feel like doing a lot of math in my head today. 9,800 times 0.02. That'll be $196. Okay. So that's your next trade. Now, if you lose that trade, then you're going to be sitting at 9604. Okay. And then 2% of that is going to be $192. And you get you can see the trend here, right? If you keep losing trades, first of all, if you lose too many trades in a row, then you're probably going to want to take a look at what's happening in the market. At this point, by the time you have gone and tested and done everything, you should know pretty well that, okay, you're going to win, 6 out of 10 or 7 out of 10 trades, right? So that's, you shouldn't be losing too many trades in a row by the time you're actually trading 2%. All right. But if that does happen, sometimes even with the best algorithm, even with the best trading method, you're going to lose a few trades in a row. It happens. I've even seen where a good solid algorithm loses like 6 or 7 trades in a row. And then, of course, that's when you start to have to rely on trading psychology and, understand that, okay, there's something going on in the market. Maybe it's low volatility. Maybe, there are some things that you look at that point. But getting to that point, that's kind of another conversation. But let's just say that the market is kind of streaky. And out of 20 trades, you lose like 12 or 13, right? as that account whittles down, each trade you lose is going to hurt less because you're only doing 2%, right? Now on the positive side of that, and then like I say, this is why your account's not going to blow up because you're always risking that same percentage of your account. So as your account gets smaller, your losses get smaller. Now, the bright side of that, as you win, the wins get bigger. So if your account starts at $10,000 like that, and 2% of 10,000 is going to be $200. So now your account is at 10,200. And then 2% of 10,200 is going to be 10,204. Then 2% of that, it's going to be 204. See that? And then after you win that trade, let's just say you're winning. Let's just say you only have a 1-to-1 risk. You're only winning $200. Because what I do here is I actually have where if I risk 200, I make 400 in this particular trade, right? So we're going to get to that. But right now we're just going to assume that if you are trading, you can either win your 2% or lose your 2% in this scenario, right? So like if you stop out, like we talked about, if you risk $200 of your book and you lose, then you lose $200. And in this one, we're going to, sorry, I'm going to interrupt this right now to answer Cloud's question. All right, so anyhow, sorry about that, everybody. So as I was saying, with the when you risk $200 in this scenario that I'm talking about, then the most you're going to win is $200, right? So if you risk 2%, the most you're going to win is 2%. So we're going to pretend that this is a 1-to-1 risk to reward ratio. We're going to get to what that means here in a minute, right? So also, back to this anyhow. So now your account is 10404. And then if you risk 2% of that after a win, then now your account is going to be 10404 times 1.02 is going to be 10612. And of course, 2% of that is going to be bigger and bigger and bigger and bigger. So it's a compounding interest situation. And compounding interest is going to work for you whether you're winning or losing because your wins get bigger and your losses get smaller. Okay, so let me make this a little cleaner on the screen. Ugh. Sorry. Let's do it this way. Okay. So this is your, if you lose, your losses get smaller. If you win, your wins get bigger. So if we go ahead and set this aside, we'll talk now about risk to reward ratio. So what you're going to do is when you develop an algorithm, ideally you will be able to develop one that allows your wins to be bigger than your losses. Okay. And I see there over there, Valley Girl, thank you in YouTube, for your thoughts there. So your risk to reward ratio is what's going to make the difference, right? If you're trading and you have a 1-to-1 risk to reward ratio, what that means is that this box is what we use, this box here, and I'm going to pretend this is a trade where price is going up. Okay, so let me move this off the screen and we'll just create a whole new scenario for the new traders, because the new traders a lot of times they're going to have a better time like imagining scenarios when the price goes up because that's what they're used to thinking about. So let's say that you're trading Bitcoin and Bitcoin goes down to $20,000 and you think it's going to go up to 30,000, right? So, $30,000 is like, let's see here. This is 20,000 right there. And this is going to be $30,000 up here. Okay. So you think the price is going to go up to make it to $30,000, right? And so what you can do is you can enter a trade. Sorry, there we go. what you can do is you can go long. So if you were to go long and you were to enter, now go long is what we mean is like by buying. Okay, you can actually go short. In fact, I did a beginner lab on that 2-3 days ago. It was called Making Money on the Way Down, and you can go to YouTube and check that out. It talks about how you can make money when the price goes down if you're new to trading. But let's say you're like right here and the price turns around and you're confident based on your algorithm that price is going to go up to 30,000. So you start a trade right there, say at 21,000. So 21,000, you enter a trade, and then price goes up to 30, and you made it. Well, what we never do is we don't. I see we got the gorillas in. So
Hello.
hello. Gorilla is here.
I'm here.
We're just talking about money management, risk to reward ratio.
Nice.
I got an email this morning from a new trader, and we actually have some brand new traders in Algo Factory. In fact, VM in our YouTube chat is in there talking to us about that. She says she's learned a lot from us, and that's a good deal.
That's awesome.
Yeah, we love to see that. And one of the questions I got was, I'm a brand new trader, and I'm watching the videos, and I just, I don't understand the terms, and so it's going to be, thanks for that, Claude. I'll throw that up. And it's going to be, if I were to make a video about every single beginning trader concept, then it would be like 1,000 videos. Trading is something where you're going to want to get it. So I did send some ideas as far as where to get the very, very basics in the email. And one of those was to watch our shows every day. So like we have this beginner live lab where we allow beginners to ask questions. And then of course, I'll design an entire around the questions that the beginners are asking. And then if there's questions, then I try to talk about some concepts. And we got about 7 minutes left to kind of does this concept, which is risk to reward ratio and money management. So I got through the money management where your losses become smaller and your wins become bigger, right? So that's where we've gotten so far. And now we're talking about how what can happen as to risk reward ratio, right? So in this case, we're talking about somebody who was watching Bitcoin go all the way down to say to 20,000, then they thought the price is going to go to 30,000, so they buy Bitcoin at 21,000, right? Well, whenever we trade, we have something called a stop loss, and we always minimize our risk to where if price goes down a certain amount, then we get out of the trade. Now, if price went from 21,000 to we're going to pretend we purchased at 20,000 because it's going to make it easier for this example. So now if price, and we're talking about a spot trade here, right? This isn't a derivative trade. So you're just buying Bitcoin. You're not playing, you're not messing with leverage or anything like that. So if price went down to 10,000, right? It's like the same distance as going up to 30,000, right? So that's the thing to understand here. So if you put say, $10,000 on this trade, and you were betting that $20,000 would go up to 30,000, then that's going to be a gain of you're essentially getting half your money, 50% gain, right? And then if price goes down to 10,000, then you're going to be losing $10,000. Price goes up to 30,000, you're going to make $10,000. Okay, so that in this particular case would be a 1-to-1 risk to reward ratio, because you are actually going to lose the same amount of money that you would win, right? I'll say this again. If price goes down to $10,000, then your value goes down from 20,000 to 10,000. You've lost $10,000. If price goes from 20,000 to 30,000, you have now gained $10,000. So this is a 1-to-1 risk to reward ratio. Okay, so I'll make this a little, more clear by using what I call a long box. It's a measurement tool, and it's going to measure for us the risk to reward ratio. You saw it earlier on the side of the screen there with the trade that I won overnight that just took profit like 10 minutes ago. But here it is. It's on the left side of the trading view screen, and you start at the entry and you stretch that out to your profit taking point, and then this down to your stop loss point. And that's that's a 1-to-1 risk to reward ratio. Look at that, 1.02, because I'm just drawing this. It's not exact, right? So, but that's a pretty good eyeball right there. I was pretty close. So that said, that means that you're cutting your loss. But why cut your losses way down here? If you know, or at least you have calculated the price is going to rise, now the trade can go against you for a minute. It can. But usually if you kind of have measured that price is going to go up, if your algorithm tells you the price is going to go up, then why take that big of a loss? Because price likely is not going to go down. And so what we do is we have methodology to determine, like, okay, if price goes past this point, then chances are it's going to continue down. But there's a point that we use mathematics and market structure, where you can kind of say, okay, I'm going to get out of the trade here, right? And what that means is that if price goes all the way up to your target, here's the thing. Let me back up. This being the case, you're going to exit your trade right there. You put $10,000 in, but right here, this is going to be something like 17,000. Just going to make that number up real quick. So we're going to say this is 17,000. Okay, so your losses are going to be limited based on where you set this. It's called a stop loss, and you're gonna lose $3,000, right? Instead of 10,000 all the way down here, you only lose 3,000. So in this case, now you're betting 3,000 to make 9,000. So actually, it would be really the answer is like 3,300. So whatever this number is, really, it's probably 1,750 or something. 1,660 actually. The real number here, now that I'm doing math in my head, is this number. So if you're at about this right here, then you're going to lose $3,300, but you're going to make $10,000, and that's a risk to reward ratio of 3-to-1, right? So you're going to win 3 times as much as you could lose, and that makes this change over here in the money management side of things, because instead of only winning 200, you're now winning 600, right? And like, your next trade is going to start at 10600, and you're going to risk 2% of that, which is going to be a bigger number. I think it's going to be 212, and then on and on. So instead of, it's just you're tripling, or it depends on how your algorithm works. Most people are sitting at like a 1.6, 1.7. That's just what I kind of get the impression in my head. And that means that as you test your algorithm, you're going to find that chances are you're going to be like, for every $100 you put in, you're going to win something like 170 or something like that. And so, and if you're, winning, say, 60, 70% of your trades, then your account's going to grow nicely. You could actually lose half your trades, but if your risk to reward ratio is better than 1-to-1, if it's like 1.7-to-1, you could lose even like 6 out of 10 trades and still be profitable. Question is, are you profitable enough, right? So anyway, this is the basics of money management, and we use this to make sure that our accounts don't get blown up. So that's that. Now I have an entire class based on this. So if you want to see what that is, you can head over to algofactory.tech. That's www.algofactory.tech, and you can actually take the classes. This is just one of the 50 some odd classes that are in there. And then also, if you are using your cell phone, you can always go ahead and click on this QR code, and that'll take you over to the website. And feel free to come on to this live session and ask questions. If this goes from 8:30 a.m. EST to 9 a.m. EST every weekday. That's not a holiday. We don't really do holidays. Like Monday was a federal holiday, so we didn't do that. But Yeah, come ask questions. I'm happy to answer them, even if you're not one of our members. Our members do have priority, though. So, a member asks a question, I'm going to answer those first. And I'll throw this link up here. This came from one of our members, Claude 2000. And that's a website to learn. It's investopedia.com, which is a great resource for just basic trading stuff. And so go check that out for risk to reward ratio. But as that is, we're going to hop off here. So we got the gorilla on to give us that gorilla send off.
Hey, folks, it's the gorilla. And look, here's the deal. If you're sitting there on the outskirts and you're wondering if this is for you, maybe you're looking at all the charts and stuff. You're like, man, this is overwhelming. I don't understand the terminology. I don't understand what the heck these guys are talking about. Look, don't worry about it. We were all in that position. Every single one of us, even the professor himself at one point was just like that. Cowboy, he didn't know trading until he decided to grab life by the horns, or the balls, as we say on Wednesdays on Gus, and dive deep into it. And that's what's going to require you guys to do. We're here to help you with that. We're here to help you with that journey. So don't worry. Don't worry about, should I do it? Should I not? Do it. Do it. You will learn through immersion here, which is the best way to learn. And wait till you join us and wait till you see what's going on in the live lab in the member section. It's going to blow your mind away. It's going to blow your mind away because you're going to get top-notch learning, top-notch education. And then every Thursday, you get to hear things that you won't hear anywhere else. Okay, so join algofactory.tech. This is a process, and it's a process that you're going to love, and it's going to be so beneficial for you. There's very few things you can do in life that you could turn into a very profitable endeavor. This is one of those things. This doesn't come around often. Join algofactory.tech. Make it happen. Don't make excuses. Don't wait till tomorrow. Do it now. You won't regret it. Cowboy, take it away.